Welcome to Alpha Recap, your after-hours market reset from stockalpha.ai. I'm glad you tuned in. As always, if you have questions, you can reach us at stockalpha.ai. Today we're breaking down a mixed day on the tape, where big tech held up while small caps took a hit. With me is Tom to walk through what drove the action and what traders should watch next. Tom, thanks for joining.
Great to be here. Lot to unpack from the close today.
Let's start with the headline numbers. Markets closed mixed. The S&P 500 closed up a fractional 0.04%. The tech-heavy Nasdaq 100 finished up about 0.32%, but the Russell 2000 plunged roughly 1.85%. That's a pretty stark split. What jumped out to you?
That divergence was the story. Broad indices barely moved, but leadership was narrow. Investors favoured large-cap, high-quality growth names, think durable earnings and AI exposure, while smaller, higher beta names sold off hard. That tells you the market was being selective about risk.
Selective risk. I like that phrase. The article highlighted sector rotation into materials and renewables. What was behind that move?
Two things. First, there were fresh headlines about rare earth deals and a push to onshore strategic materials, and that made miners and specialty materials names more attractive. Second, we saw project announcements around offshore wind and storage, particularly in the North Sea, which helped utilities and renewables-linked names. So investors rotated into tangible, policy-driven cyclicals that are less sensitive to interest rate moves.
So while tech was holding up because of earnings visibility and AI narratives, real asset sectors were getting a policy and supply chain bump. How did energy behave?
Energy was mixed, but constructive in parts. Offshore wind and storage momentum helped some integrated and services names. But natural gas headlines kept traditional exploration and production volatility high. There was a note from Goldman saying gas prices may have overshot, and that headline creates two-way risk.
Communications and media had some noise too, with a regulatory probe. Walk us through what happened there.
Ofcom opened a probe into WhatsApp data practices, and that put a cloud over some large-cap social names. Even with decent ad demand, regulatory headlines can sap investor confidence because they add uncertainty to data flows and moderation rules, which can matter for monetization down the road.
Turning to financials, the article mentioned an FDIC-related tailwind for auto-focused banks. What was that about?
The FDIC cleared certain activities for auto specialty banks, which traders read as supportive for lenders that do a lot of vehicle finance. That was a modest positive for that niche, though broader banking momentum was muted as investors sifted through a slew of 8K filings and legal updates.
Speaking of filings and company-specific moves, a few names stood out. Intel had an earnings day reaction, Meta got hit by the Ofcom probe, and then there was an odd foresight print. Can you explain what traders were parsing?
Sure. Intel's results and forward commentary remained a focal point for semiconductor sentiment. Guidance and capital allocation matter a lot for the supply chain. Meta faced regulatory chatter because of the Ofcom action, which pressured communication stocks. Then Foresight posted GAAP earnings per share of $2,177 and revenue of $153 million. Those numbers are outsized relative to expectations, so traders debated whether that was sustainable or simply accounting timing. All of this reinforced the theme that a few company-specific events were driving pockets of volatility.
There were also a bunch of 8K filings across smaller names, including Matador Resources. How did that affect market action?
A flurry of 8Ks kept desks busy. On their own, they weren't market moving, but they contributed to a sense of stock-specific, event-driven trading, especially in mid and small caps. Combined with profit-taking, that helped push the Russell 2000 lower.
Let's unpack the macro picture. There weren't any shocking prints today, but how were traders thinking about the Fed and the path of policy?
The market continued to price a slower path to easing rather than an imminent pivot. In plain English, investors expected the Fed to stay data-dependent and patient. That steadied long-duration growth names a bit because firms with predictable earnings streams look safer if rates don't drop quickly. Conversely, small caps, which tend to be rate and growth sensitive and often have less earnings visibility, sold off.
So a steady Fed helped tech hold up, while small caps were punished because they're more rate sensitive and riskier. How did that show up in the market internals and breadth?
Breadth was narrow. You had concentrated strength in large cap tech while small and mid cap breadth lagged. That kind of narrow leadership makes any rally less durable. You need more names participating for a sustainable advance. Momentum was selective, and the big move down in IWM reminded traders that downside can be swift in higher beta segments.
That's useful. If you're a trader listening right now, what should you be watching heading into the next session?
3 practical things. 1. The earnings cadence, especially from tech suppliers, consumer discretionary and financials, will tell you if QQQ leadership broadens or stays isolated. 2. Policy and regulation headlines. Any follow-up on cannabis bills, the Ofcom probe, or renewable project approvals could move sectors. 3. Commodities and flow. Natural gas commentary and rare earth deal details will influence materials and energy plays, and intraday breadth and IWM technicals will show whether small caps can stabilize.
How would you position as a trader versus a longer-term investor given this backdrop?
For traders, favor names with clear near-term catalysts, earnings beats, contract wins, regulatory approvals, and use tight stops in small cap positions. If you're in thinly traded event names, consider selling into strength. For investors, maintain exposure to high-quality growth with secular tailwinds like AI and cloud, and consider rotating some marginal allocations into materials and renewable infrastructure that benefit from policy and supply chain retooling. In short, stay selective and focus on liquidity and durability.
Let's give listeners a plain English cheat sheet. 3 takeaways from today's close.
1. The market was selective. Large cap tech held up while small caps sold off hard. 2. Materials and renewables outperformed on policy and supply chain narratives, showing rotation into tangible, commodity-linked sectors. 3. Breadth was narrow, so any sustainable rally will need more participation beyond a handful of big names.
Before we wrap, anything else on the watch list? Maybe late week data or Fed speakers?
Watch payrolls and CPI updates later this quarter, and Fed speakers for any shifts in tone. Also keep an eye on fiscal or policy moves that could alter sector leadership. Cannabis reform or renewable incentives could trigger targeted flows.
Perfect. Thanks for that clear rundown. To recap quickly, the S&P 500 closed up a fractional 0.04%, the Nasdaq 100 finished up about 0.32%, and the Russell 2000 sank about 1.85%. Tech held up, materials and renewables rallied on policy and commodity stories, and small caps pulled back sharply. Be selective, focus on liquidity, and watch earnings, policy, and commodity headlines next.
Exactly. They let selective risk, not blanket risk on. That's been the market's MO lately.
All right, that's a wrap for today's Alpha Recap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll see you after the next close.